Hello, friends. Today I have a very special guest, Mr. Sivaramakrishnan, who is the co-founder and chief investment officer of Sincere Syndication, which is a SEBI-registered global asset management platform serving clients across 45 plus countries, managing over 2,000 crores of capital. This institution operates as a multi-family office and fund management platform offering AIFs, AIF, PMS mandates, and bespoke investment solutions across global markets and multiple asset classes, including listed equities, private investments, real assets, and structured opportunities. Mr. Sivaramakrishnan is an investor, entrepreneur, and institution builder with over 2.5 years of decades of experience across capital markets, corporate strategy, and investment banking. He is a chartered accountant by qualification. Welcome, Mr. Sivaramakrishnan.
Thank you, sir. Thanks for the brief introduction.
Yeah. And today, Mr. Sivaramakrishnan, I will have the entire discussion focused on our Bharat Transformation Fund, the AIF, which we have recently launched, and I just want this fund attributes and its features and benefits to reach out to my audience at large. Fine. Just wanted to identify, sir, since this is an category 2 AF, which has got a good mix of private equity listed as well as startup ecosystem. I wanted to know how do you identify companies in unlisted space which are innovative and looking for scale?
Yeah. So, while I answer this question, the first part is what kind of companies do you invest in? When I propose those set of companies, then probably can tell you how do you identify them. See, today in the listed space, valuations as they were in 2016 is very different from what it is today, right? We used to be running at valuations of something like about 15, 16 times of on PE ratios in 2014, 15. If you remember those days, Venkat sir, have been around for a long time. Right. Today, if you remember 2014-15, there were times when 15, 16 times of on P ratio was sounding costly, expensive, right? Today, 22 times doesn't sound expensive. So I still call it fair and reasonable. Therefore, valuations have galloped quite a lot. Now, end of the day, the way investor makes money is not by investing in great companies. That's not the only way. The important way, reason why people make money, outlier returns are achieved not in just investing in great companies, by investing in them at good valuations. Valuations form the bedrock of wealth creation, right? So from that perspective, we find enormous opportunity coming in the pre-IPO space, right? To give it a context, pre-IPO is all about entering companies before they are discovered. That's it. Before they are discovered by public. Now, once it gets discovered, good companies, I'm not talking about the bad ones, but good companies get discovered. Obviously, the valuations multiples can keep expanding, can get re-rated as they keep doing well. Now, if you are able to discover them probably about 12 months to 18 months before IPO, right, and get it at a discount, which is somewhere between 50% to 80% to the valuations of listed peers, right, then you got a fantastic opportunity to invest in. For instance, a defense company running at a valuation of 50, 60 times in the market, in the listed market. A similar company in the unlisted space, a pre-IPO space, could be available at about 10, 15 times of earnings, 15, 20 times of earnings, which is about almost about 60 to 80% discount to the valuations of listed enterprises. If this were to be an opportunity, just look at it this way: does the listed markets running at about 60 times of earnings provide margin of safety, or just on valuation metric alone, a company running at about 15, 20 times of earnings with similar profile, similar founders, institution grade governance standards, everything else in place, which offers higher margin of safety, right? So the answer is obvious. Therefore, this is the space that you're going to be focusing on. About 70% of the money goes into pre-IPO opportunities, and 30% of the money goes into listed entities. Now, listed entities, obviously, we know how to discover. I mean, there is a methodology to the madness. We have a transformative framework to identify listed companies. Now, when it comes to the pre-IPO space, how do you discover entities, right? See, if we do a deep dive down into the corporate library of India, walk down into the doors of investment bankers, merchant bankers, right, and auditors particularly, right. See, we are in a space where we have been around for the last 25 years. I have been myself a banker, and the team members around, the committee members around, have all been ex-bankers, ex-investment bankers, investment managers themselves. Therefore, we have access to as much as several tens of hundreds of companies around across India, which are up for IPO for the next 12 months to 24 months time frame. Right now, identifying these, spotting these companies is not hard. But the next question is this: due diligence, because you don't have history of numbers, right? You don't have 5 years, 10 years history of
The
revenue.
disclosure can be once in 6 months, unlike yeah,
Yeah.
invested
In
3 months.
fact,
Yeah.
there's no need for disclosure to public at large. Basically, it's only an audited report that is get publishing every year, end of every year, right? So we need to go beyond numbers, just not numbers. You need to go beyond numbers, meet them, visit the factory, spend time with them. That's how we identify this answer. It's not about spotting the companies, but it's about being with them, traveling with them for several weeks, spending so much time with them, doing hardcore due diligence on them. Right? It's original research that we do. It's through this process that we shortlist these companies. Our success ratio in filtering companies is probably in the order of good companies which are referred to us by valuable sources. Out of 10 companies, probably end up choosing one of them, or 1 out of 20, I would say, is probably the ratio of the choices that we could make out of the companies that come to us. That's how we pick up, and probably a very small percentage of we intend to keep set aside about 5% of the corpus towards investments in early stage ideas, which are companies that could get listed not in 18 to 24 months, but which could get listed over the next 3 to 4 years, or disruptive startups. Right? With this disruptive startups and early stage ideas, we would prefer to do co-investing with other funds, other venture capital funds, because they need more access to capital. With pre-IPO companies, it's more or less this is the last stage of investment before they go for IPO. They may not need further capital, right? So therefore, it's one step before IPO. But those other companies, with very, very small percentage of capital, because that's a risk capital. 5% of the capital they're going to set
Yeah, you
aside every.
have 5 to 15% only. Yeah,
Yeah,
in that.
you want to limit it to single digits, a very small percentage, and that investment could fetch multifold returns of 10, 20x also. But that's a risk capital, right? Therefore, we're going to limit it, and we're going to be co-investing with a few other eminent investors or funds, so that the company will have access to more capital in the times to come.
Wonderful, sir. And when I gone through the presentation, I have identified some of the very unique sectors, something like defense technology, deep tech, aerospace manufacturing, precision engineering, consumer products. So you have a very niche product segment and the most happening segment also. So can you throw some experience of those founders and what is their vision and how do you look at their next 5 years growth on that?
Yeah. So how do we identify these sectors? Why do we name these sectors? Like you said, sir, these are some of the most happening sectors at this point in time, 3 to 4 years ahead. So there is fundamentally one basic principle that there is an English phrase: "The rising tide will lift all the boats." Up, right? If you're going to be part of the right industry, first of all, industry with back the huge tailwinds, half the work is done. Half the work is done when you are part of the right industry. You may be sitting on fantastic entrepreneurs, but they are not part of great industries or industries that are, course of sunset or moderate growth industries. You're not going to find that kind of rampant growth, right? So identifying the industry is 50% of the work, right? So that it's all a significant part of the problem. Now, these industries that you mentioned, the ones such as aerospace, defense, precision engineering, IP-led manufacturing, and affluent consumption. These industries, electronics, of course, semiconductors, these are industries which are inherently growing at more than 15% per annum. Right? Now, how do we identify this? There's one particular simple underlying logic, hugely tailwind back. They're hugely tailwind back. A tailwind is one, the wind blows as you row the boat. The wind that blows from behind is tailwind. Right? The wind, if it's going to be blowing from front, it's going to hold your pace. But something that blows up from behind the back, right, will push you forward. Likewise, here the entrepreneurs and the management team are the ones who are going to sail the boat of enterprise. The winds are going to be blowing from behind. That's going to be pushing them up. The least of effort is going to be they're going to be pushed forward, right? That's a sort of industry that we've chosen. So what is a tailwind here, Venkat sir? Now, tailwind is something that I may identify something to be an industry, to be a tailwind-backed industry, but you may say no, that's not. What's a tailwind here? See, that's a very very interesting point, a nuanced point. For all the viewers here, it should be very interesting to note that who the largest investor in India is. Sir, who is the largest investor in India?
It's all the Mukesh Ambani's and all the venture capitalists, basically.
It's actually
Yeah,
government of
government of India. Okay, yeah,
right. because
The amount of incubation centers what they are putting in on the education institutions is very high. Yeah.
you are right. Not only that, they own large enterprise public sector companies, right? And through LICs of India and through other public sector companies, they own huge stakes in across corporate India, right? Literally, they own, when we calculated, they own as much as 18% of corporate India is held by the government of itself, India itself, right? So they call the shots. They call the shots. They are the biggest movers. So once they find that, well, this is a space that should move fast. For example, they said that renewable energy should do well, alternative energy should do well, right? The industry is moving fast. Once they decide that, well, payments as an industry should do well, right? Payments industry is doing pretty well, moving very fast, right?
Yeah,
UPS
we are
companies,
the
TCS,
pioneers in the world. Yeah.
exactly. We are the pioneers in the world. So they are the ones who are setting the pace. Now, the way to understand what a tailwind backed industry is, just not a thing too complex, not a complex subject, very simple. Understand as to what the government decides as to what the tailwind backed industries are. What's the government's direction? Just fall in line with it. Instead of falling apart, just fall in line with it. As long as we are aligned with the government's vision and mission, we are investing in tailwind backed industries. Just identify those areas. And so what is it all about defense? Now, defense market size in India is something like 1.86 lakh crores of capex that India does on defense every year. 1.86 lakh crores of capex, right? Another 3.5 lakh, 3.5 lakh crores of OPEX, operational spends that they do. Now, more than 78-80% of the entire amount is spent on imports. That's what the scenario was in 2000 until 2019. Suddenly, the situation changed, and today government wants to indigenize as much as 76% of the manufactured components within India, right? Either with our own technology or with technology that is imported, right? Either of these two, but it should be manufactured in India. Now, what's happening in the first phase of development of the defense industry in India between 2000, let's say 2015 to 2022-23, we were largely importing the technology on more of set up more of an assembly unit in India and manufacture and send it across to the DRDOs, armies, and navy of the world, right? But today, in the last 4 to 5 years, on account of the way we have worked in the last 10-15 years, right, with all this backlog of research that we have done, India is evolving into IP-driven defense enterprise, base. Right, so much of defense technologies are emerging in India. With this emergence of defense technologies, we are in a fantastic position to be able to not only to supply to Indian Army and Navy, to the Air Force, but we are also in a position to be able to export these defense products and services to the world at large. And as it has happened in software and healthcare, the cost of our pricing, the pricing power, we have a significant pricing power compared to the developed markets, right? Our products can be much cheaper than the US products from the US or from elsewhere, except for China, right? And Chinese products are not favored across the world. Therefore, India, when it's able to supply globally, it's a very advantageous position. Let me take our case of another industry, which is aerospace, Venkat sir. Aerospace globally today is about $240 billion. Viewers, please note the numbers carefully, because the reason I'm rattling some numbers, very important reason I'm telling you this. Interesting to understand. $240 billion industry today. The largest player in the industry are Boeing and the Airbus. They're the largest manufacturers of commercial aircraft, right? You know what? You're going to be ordering an aircraft today. It's going to be delivered after 12 years from now, because these two companies are sitting on 11 and a half years of order book. 11 and a half years of order book, right? And the other players in this industry are Pratt and Whitney, right? They players like GE Aerospace, and there's a company called Embraer, Lockheed Martin, right? Now, the point is this $240 billion industry is growing to become about $400 billion industry by 2030. That's a pace of growth of global aerospace industry. Now, what will be the market share of India in this industry? What do you think market share, sir? It's only less than 1%.
It should be very less. Yeah.
Very, very
Yeah.
less.
Currently.
$1.5 billion that we are exporting to these companies. But is China the largest player? No, China is not the largest player, unlike other industries. The largest players in the industry are from the US and Europe only. 85% of the entire aerospace industry is concentrated between US and Europe. What's happening in Europe is that the components that are getting manufactured in Europe are becoming more costlier. They are becoming costlier. Right? And manufacturing process itself is becoming difficult there. Therefore, lack of availability of manpower and various other reasons. Now, that production is getting shifted from Europe into India, from US into India, right? To give a highlight of that, there's there's something certification called AS 9001, right? companies that have got the certification, even started supplying to any of these companies such as Boeing and Aerospace, are getting flooded with orders today. They're receiving orders big time, and these companies in India, aerospace companies in India, are growing at something like about nothing less than potential to grow is something nothing less than 30%. It has a sort of potential that India holds. Even if this $1.5 billion of total market size in India, out of this $240 billion, $1.5 billion, let's say somewhere in the Europe, somewhere from the Europe, $2 to $3 billion get thrown away from Europe and falls upon India, $3 billion. Indian market size becomes 1.5 plus 3, 4, and 4.5, tripling of the market size, right? The aerospace is going to be much
From
larger.
a low base, we will increase to a much higher
The base
base.
is
Yeah.
very small. And for that matter, all these companies, surprisingly, you see, there are probably about 200 plus countries across the world. India is the only country where in 2026 and 27, between these 2 years, these companies, Boeing, Airbus, Lockheed Martin, all the three companies are setting up their own factories. No other country is going to be seeing this kind of privilege. All the three companies are setting up factories in India to supply to Indian domestic demand. Now, we are not talking about the Indian domestic demand. Just supplying to the global demand alone is going to grow the industry by 3x. So, therefore, large part of our work is about identifying these opportunities. And we are today, as we speak, we are evaluating about 4 defense companies. We have committed to invest in one defense company today. Just to give a highlight of the question that you are going back to a specific question, what the founder feels, how is he looking at things, right? So, here is a founder, instead of reinventing the technology himself, has signed up with Israeli companies. Right, the best of the companies in Israel, and building technology, set up a manufacturing facility in India, and supplying what is called as loitering munitions. Loitering munition is nothing but a UAV, that is unmanned vehicle that chases a moving target. Right, the target moves and it keeps moving along. Basically, it can chase and hit another missile. Moving missile can be chased and hit using heat map that gets generated out of the missile, right? Out of the missile. Now, the profits of this company is likely to be around 55 crores or 55, 60 crores for this financial year, FY26. Now, for the next financial year, based on orders on hand already, the profits can be in the order of about 150 to 180 crores. 150 to 180 crores, growing from 60 crores. The previous year, the profit was 20 crores. Venkat sir, the interesting point is this, just not about growth in profits. The most interesting point is that when such a company is in the listed space, right, 150 crores of profits, growing doubling their profits, what do you think will be the P multiple, sir? 70 times, 80 times, 100 times, right? Some exorbitant P multiple. Let's take it at 60 times, 50 times also, least of the P multiples. The company could be valued at about 7,500 crores next year, right? Now, the most interesting point is that we are able to enter this company at a valuation of 1,500 crores, which is 10 times of profits of next year, versus potentially a 50 times profits where it could get listed at. This company is likely to get listed by end of this financial year or beginning of next financial year, based on the numbers of FY27. Therefore, if it gets listed at, let's say, 6,000 crores, 7,500 crores, or 9,000 crores, you're today entering at a valuation of 1,500 crores, provides us an upside of 4x, 5x, or 6x,
4 to 5x. Yeah.
This
is phenomenal within that period. Yeah.
Just an example. There are many more such opportunities. The only important point is that we have to fold up our sleeves and go to the shop floor, be with them, understand them, spend a lot of time in evaluating them. Very, very exciting times. Very exciting times. Right? India is moving from a commoditized manufacturing zone to an IP-led manufacturing zone. Right? There is one other very interesting data-led AI company that we are evaluating today at about 15 times potential to enter at about 14, 15 times of earnings. Right? This company's profits are growing at about 50, 60%. Their customers include the likes of OpenAI, Microsoft, Samsung, LG. They are providing synthetic data to those companies. Right? Now, growing at about 50, 60%, potentially this company could be valued at nothing less than 25 times of earnings for the listed market. Right? If they do about, let's say, 140, 150 crores of profits, 25 times multiple could take them to about roughly 3,500 crores of valuation. Today, we have an opportunity to enter into this company at about 1,000 crores in valuation. Right? So that's about potentially a 2x, 3x bagger from where we are today. So therefore, quite a lot of opportunities around in pre-IPO space. So when I talk about pre-IPO, generally it is understood to be talking about likes of with due respect, companies such as Swiggy or National Stock Exchange or Tata Capital, these companies are normally ones which are already available in retail domain. If you open ICICI Direct or HDFC Securities for that matter, any Zerodha, right? These companies are already available to be bought by retail enterprise, retail investors. Valuations of these companies are already completely sucked out. These are not the pre-IPO opportunities we're talking about. We are talking about original research and identifying the best of companies to go in and invest in them.
Very well put across, sir. And I understand that your drawdown starts with 50 lakhs initially and 25 lakhs, 25 lakhs. So, how soon you want to complete the drawdown, or when will be the final close of this AIF?
Honestly, we were looking at closing by May 2026 originally.
May 2026. Yeah.
Original that was the thought process, but when you look at the kind of quantum that is coming in today, we may and also the opportunity that's heading today, uh, we might be should be closing this investment by uh, probably by April first week, right? First, this is going to be Bharat Transformation Fund Series 1. We plan to close this fund by April first week, and the initial drawdown could be about 35 to 45%. Let's say 40% of the capital, where 30% goes into listed entities, 70% goes into pre-IPO opportunities, and balance of 60% is likely to be drawn over a period of 12 months odd. Right? Gradually, we would like to draw down gradually and deploy money gradually. We're not in any sort of hurry to deploy money. And Series 2 of Bharat Transformation Fund could somewhere sometime end of this year. We plan to raise 350 crores in the order of that every fund and deploy that over 12 to 15 months time period.
Wonderful. Very nice. And I also seen that the hurdle rate is kept at 14%, which is quite good in the category 2 AF and
So,
with a
all right.
catch up option. So,
Let me
yeah.
take probably 3-4 minutes quickly to tell you why this hurdle rate is 14% and why we identify the sectors. Right? There is some important rationale behind that. We have all been not been pure play investors all through 25 years of career. I used to be CEO of a coal company, a power company earlier. I was head of a bank in Chennai earlier. So we all come from. We used to be mining coal and exporting coal from out of Indonesia into other countries, setting 2 power plants. So likewise, our other members in the system, we are about 20-year-old enterprise. Other members in the system, senior members in the system, are all from the industry. We don't calculate and invest from Excel sheets. Right? Excel sheet, if you punch in 20%, everything changes. Make it 30% changes further, right? So it's all just numbers. We look at what's happening on the ground. The last 25 years of our careers, we figure out that the key elements in we help getting companies to grow by 50x, 100x. Right? You've seen Bajaj Finance grow so significantly. PA industries. I mean, so many such examples of enterprises have grown by 100x in India. Right? Now, these companies have become 100x not because of their ratio analysis, not because of ratios in the companies, but we realize that there are some softer aspects, Venkat sir, that got these companies to grow as big as this. The joy is not identifying these companies after they have become, larger as they are, right? The joy is in identifying well before that. Now, how do you do that? The way to be doing that is based on these 4 factors. We found that these are the 4 factors that were resident in each one of those 100x companies, 100x, 50x companies. These 4 factors were the driving ones for any of those companies to become this 100x, 50x. What are those factors? Number 1, we invest only in visionary entrepreneurs. The entrepreneur has to be visionary. You should be able to see things that a common man does not see, right? What a common man sees, others he should not be able to see. Just take the case of, with all due respects to what the chairman of Adani Group has done, right? Whatever be the controversy, set them apart. If you have gone to Mundra about 20 years ago, it was barren land. Nothing was there. A port came out of it from nowhere, right? Today it's a flourishing place. Mundra is a flourishing place, right? Likewise, several other enterprises have scaled up from Jamnagar. Go to Jamnagar about 40 years ago, it was nothing. There's absolutely nothing. Today it's housing one of the largest refineries in the world. That's a visionary. Able to think, he thought about, envisioned those buildings, envisioned those structures when it was just a barren land. That's a capability of visionary entrepreneur, right? Visionary entrepreneur should be fearless. If he's failing, then he cannot scale up, right? That's visionary entrepreneur. We invest only in visionary entrepreneurs, not in incremental growth of 10-15%. Visionary entrepreneur is the only one we invest in. Now, this visionary entrepreneur if he's doing business in an industry that is not growing fast. For example, if he's part of a textile industry, right? Now, what can he do? He can only add more spindles. He can add another 200, 300 more spindles. With all, good industry, but it's not industry where he can apply all the creativity, right? Oh, visionary entrepreneur present in an industry which is itself growing at about 20% span. If that would be the combination, then can this visionary entrepreneur not grow his enterprise in that industry at least a 2x of or 3x of the industry's growth rate? The industry is growing at 20%. Can he grow at 40% or 60%? Well, that's possible if he's a visionary entrepreneur and if it's a tailwind backed industry. So, visionary entrepreneur in a hugely tailwind backed industry. Right? These are two factors. Now, it doesn't stop there. One of the biggest problems of failure has been that when you go to enterprise, Venkat sir, when we do due diligence in many companies, some of the smaller listed companies also, it's strange to find that who is the CFO when you ask this question. The CFO is promoter's brother's son. Right? Who is the CTO? Promoter's wife is CTO. Well, they could, but it doesn't instill confidence. It doesn't provide institutional governance at
It is
all.
not professionally run. Yeah.
Exactly, sir. So, a visionary entrepreneur in a tailwind backed industry, but backed by a professional management. Very important, very, very important. A promoter is not a one-man army to be able to succeed. You should have a team of people, an army of people who have got a phenomenal background in their own careers. Oh, interesting point is this. One important reason why we have seen many of our investments did well is that, when you find a CFO that's come with about 25 years of experience, let's say 25 years of experience coming to the company, he would not want to throw his career at risk, right, by doing something murky, right, because he's got a background himself. So, a professionally experienced CFO, good qualification, with a good qualification, when he comes into an enterprise, half the problem is already solved because from a governance perspective, he knows how to set up the governance. He will not want to do anything wrong, right? Therefore, visionary entrepreneur, tailored back industry, backed by professional management, and finally, solving a critical problem in the society, right? There are two kinds of enterprises, Venkat sir. One is where somebody tries to create a solution when there is no problem. For example, WhatsApp or Facebook. Nothing of that existed about 20 years ago, right? Now it has become a need for you cannot survey without WhatsApp and Facebook, right? Instead, likewise Instagram. Now this is creation of a need. Creation of a need is possible for Meta or for Mukesh Ambani, but it is not possible for Venkat sir or for me, for that matter, any of our entrepreneurs. So that means huge scale, huge fund backup, right? Now this is creating a need is not what you want to focus. You want to focus on companies that solve a problem, and the depth of the problem that they solve. The depth of the problem that they solve creates longevity of the business, right? So if they can provide critical solutions to problems which are very deep, then the company will have the ability to last for a considerable period of time, right? The longevity of the enterprise is ensured. So that creates a moat. Moat is coming from solving critical problems. So therefore, these are the 4 points. Sir. Visionary entrepreneurs in tail impact industries, backed by professional management and solving critical problems. It is on these 4 elements that we pick up companies. Right? On the foundation of that, we look at the valuations of companies. They are all right. If all these are set, right, then it comes to our investment framework. We got an investment committee here with diverse backgrounds. Gentlemen, chartered accountants with about 2 chartered accountants about 20, 25 years of experience. Myself and Ramesh Narayan. Ramesh Narayan was CEO of Aerospace earlier. He was CEO of A2B. Right? He was managing an entity of 1,500 crores of revenues. He stepped out and joined us. And then there is one Mr. Vineet. Vineet is an AI engineer, comes with about 30 years of background. And there are a couple of other eminent people, another senior chartered accountant with about 30 years of experience. And there is one gentleman who is the head of SIDBI, is going to be coming on board with us shortly. So that's an investment committee. And there's also another chartered accountant with about 32 years of experience. He's been part of varied industries, right? So this is the committee of people who come with rich experience in industry, not only in investing. Right? We understand the industry and we come from the industry to what is good for an entrepreneur is also good for an investor. Right? So we come from the background of being entrepreneurs coming to become investors. It's with these lens that we identify. Therefore, we firmly believe that setting a high kind of 14% and hurdle rate is quite achievable and we are very comfortable. It's the highest in the list. As far as you know, no fund in India throws up anything more than 14% in India. Probably you will have a better idea. Could correct me if I'm wrong. They are quite confident of hitting and crossing that mark, so we kept it at that point.
Yeah, and I would want to see the Bharat Transformation Fund coming with multiple series so that the investors at large will get benefited across the country, especially in those AF category
Yes, sir.
with this. And thank you very much for spending your invaluable time and explaining the entire risk process, the how to identify the companies and what are all the hidden opportunities available in the investment thing. And we look forward to join with you and take this forward with our investors also. And thank you very much for sparing your time. And we will meet again in the due course of time for a further investment opportunity.
Sure.
Thank you very much,
Venkatramana
sir.
sir, thank you so much. Thanks for this initiative. Thanks for hosting me on this.